Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. I've got two paper money trades for you today in two high-profile names. We're going to look at Apple or we're going to look at Tesla. And we're going to look at them from a perspective of looking at the implied volatility in the VIX right now that currently sits at 50. So that's how, with high implied volatility, we're going to work from a buy low, sell high in terms of implied volatility. So let's get to our first trade of the day, and that is Apple. Apple, both dates we're going to use today is May 2nd, okay? We're going to go out to the May 2nd expiration. Sell the 160, 150 put vertical in Apple. Now, if you look out till May 2nd, the expected move, $26. So we're selling about $18 lower when the move is 26, a little more aggressive than the implied volatility shows. So we sold the 160, 150 put vertical, and I'll explain to you why. We sold that for around $2.10 credit. It's trading about $195 now, as all stocks have rallied slightly today. But several things that you're doing here. Number one, this is a high probability spread. Number two, it is risk defined. Number three, it is collecting theta. And here's the number four, it is short vega in a high implied volatility environment, which means it will benefit from implied volatility going down. The reason it's trading close to $2 is because of that 50 VIX level. So the risk on this trade, the difference between the $10 strikes and whatever credit you take in. If you take in 210, it's $790. If you take in 190, it's $810. The max profit you can make on this is whatever credit you take in. It's 210, if it's 195, whatever credit you take in, that's your max profit. This is a spread that you would do if you're passively bullish in Apple, okay? Because this one can still be profitable on the downside, but you don't want to move through the 160 strike. It is profitable if you stay right here. It's profitable if you go up over the next couple of weeks, and it's profitable if you even go down slightly, as long as you don't go through the 160 strike, okay? The break even, like I said, is the short strike minus the credit taken in is the break even on this trade. All right, there's our first one. Now let's go to Tesla, our second trade of the day, and we're going to do something very similar. Now, we've done a lot of call diagonals in Tesla, but implied volatility has flipped the risk, where if you're long call diagonals, and you can still do those, there is some vega risk if implied volatility were to come down. If you are passively bullish on Tesla, you can go out to the May 2nd, sell the 200, 190 put vertical. That's collecting about $2.70. It's trading about $2.60 now, so it's come in slightly since then. Remember, the risk on this trade is the width of the strikes, in this case $10, minus whatever credit you take in. The max profit on this trade is the credit taking in. And again, this is high probability, collecting theta, and risk defined, okay? So these trades are profitable if you stay right here. They're profitable if Tesla were to move higher. This is a bullish trade. It gives you about 4.5 long deltas. And it's profitable even if you go down, as long as it doesn't breach that $200 spread and work towards that break even. So two trades focusing on short vega and passively long deltas in Apple and in Tesla, taking advantage of this higher levels of implied volatility, which means higher premium in the options, which means higher levels of theoretical theta. All right, that's our show for today, everyone. We'll see you tomorrow with another edition of the Daily Trader. I'm Kevin Hincks.